Good morning, everybody. Thanks for joining. Today I want to talk to you guys about NOI, cap rate, and how that relates to the value or purchase price of a property. So I do apologize. I get really excited about this, so I'm going to try to tone it down a little bit for this video. Okay? So just to quick define these terms, NOI is net operating income. Okay, it is kind of, I don't want to say the end all be all, but it is very, very, very important when valuing commercial property. Now that is going to be anything 5 units and above. Okay, so essentially, typically in a single family house, a duplex, triplex, or fourplex, this doesn't necessarily factor in. Sometimes people run it on that, but commercial property is valued purely based off of the income. Okay, sometimes the location will kind of amplify certain factors of that, but the income is very important when you go into the commercial realm. All right, so we have the NOI, the net operating income. All right, then defining the cap rate. Okay, so the cap rate is essentially, it's going to be a percentage, okay, of what someone would pay, a return they're expecting if they were to pay all cash. Okay, in Sioux Falls, the area, I've seen this range as far as everywhere from, let's say, 5 cap, okay, this is always going to be in a percentage, up to a 10 cap, okay, and this is what someone is willing to pay. Let's say the bulk of the investors, the purchase price, the value of a property that they feel is there, they would, maybe they're coming from California and they don't need a huge return, they might pay valuing something based on a 5 cap, where the rest of the investors in the area would only want to pay like a 7 or an 8 cap. Okay, so it is going to be a range. It's not like this specific one, it might be listed at a 7.2 cap, but it might actually sell for a 7.1 cap. And maybe you would value it wanting to buy it at an 8 cap. Okay, but once you have 2 of these numbers locked in, you can figure out what the other ones are. So just to give you a better example here, the let's just say a $100,000 property. Okay, so it's a $100,000 property. Now this would be hard to imagine that this would be 5+ units at that price, but just go with me here as far as nice round numbers. Okay, so a $100,000 property. Let's say you take in the income after all the expenses, the net. Okay, so gross before expenses, net is after expenses. So what you're netting at the end of the year, we do annual here, would be $10,000. Okay, so $10,000 in this example. You'd plug that in for the NOI, all right, and then we know the value of the property because we paid $100,000 for it. All right, well, 10 divided by the cap rate equals the value. Okay, I'm trying to do this in my head, and I know what the answer is, and I'm just questioning myself, and I don't know why. Okay, because essentially that would be 10%, right? You guys can check your calculators, and that works. Okay, so you'd get a 10% return on your money if you paid all cash. All right. Now, if you financed up to 100% of it, it would still be a 10 cap, but that wouldn't be your return anymore. That would just be the capitalization rate. Okay, so the value of the property, the net operating income, and then that how much people are willing to pay for it, or how much did they pay for it. Okay, so it's essentially a factor, that percentage. That's how they're all related together. Okay. So when you're going to try to analyze these and figure out what your purchase price or value should be, when you're analyzing these, essentially you will go ahead and ask the broker for the T12, which stands for the trailing 12, and then also for the rent roll, the double R there. Okay, so then you're going to be able to see what the expenses should be, the rent roll, and then the T12, what the income and expenses have been the trailing 12 months. Okay, so both of those will allow you to figure out what the actual NOI is, because when you're trying to figure out the purchase price here, the net operating income can change in the future, but you should not base it off pure pro forma, but actually base it off of what it actually has been performing the last couple years, or at least the last 12 months, because things can kind of change from year to year. All right, so the last 12 months, because it's performed this way, then I know what the net operating income has been. You file it on taxes and stuff. Okay, so I know what the NOI is. and then I want to pay this for it. And let's say, okay, the apartments are going for, let's say, a 7 cap, okay? So then you would plug it in. I know what the NOI is, divided by 0.07 because it's a percentage, and then that spits out what your purchase price should be. Now, maybe it's, again, listed at a 7.2 cap, and then it actually sells for a 7.1 cap, okay? Or maybe someone overpays and pays 5 cap on this really, really nice property. Or maybe it takes a lot of work and it's in a kind of sketch area, and if you do all the work yourself, you could maybe get a 10 cap on it. Okay, so that can change as far as that goes. All right, so just a quick review here, and then I'm going to tell you why I get really excited about this as far as when you get to the ownership side of it. Okay, so again, we kind of have our ranges and the value. These three, you can plug them in. If you guys do have questions specifically on this, go ahead and comment below. I would love to answer all those that I can. If you live in the Sioux Falls area, throw me some numbers. Let's go look at it, and we can look at historicals. And I do this stuff all the time. I love it. Okay, so let's say that when we're implementing this, that we've purchased a property. Okay, so the value that is set. The purchase price, that's yesterday, okay? Because we've already bought it. All right, so now we're not really going to figure the purchase price because we're trying to figure it today. All right, so the purchase price is set, and the cap rate. Cap rates, just like all real estate, can change. Now, the cool thing about real estate is it doesn't change very fast. Okay, very fast. So if you bought it yesterday at a 7 cap, well, chances are that someone else would buy it today at a 7 cap as well. And then maybe in a couple months, maybe even 6 months from now. Now, in, let's say, 18, 24 months from now, we might want to say, well, maybe the market will shift and someone won't pay as much, so I'm going to be conservative and say it'll sell at an 8 cap. Okay, so you can do that. But just for simplicity's sake, let's say you sell it at the same cap rate that you bought it for. All right, so this is what you can tweak. The value is going to be the outcome. The cap rate, again, let's say someone would pay a 7 cap, so let's say that's 0.07 is what we divide by to get the value. So the net operating income, if the rents go up, or you start allowing pets and now you have some pet income, or you have better machines so people use the washer and dryers more often, there's all those income, okay, so that can change, raising the NOI. But you can also, by decreasing the expenses, so what I ended up doing is I actually was able to lower the water bill. Okay, so let's say that because there was leaks before and I purchased it based on the net operating income of the trailing 12 when there was a lot of water leaks. So now I fixed the deferred maintenance, and now tenants are happier too, okay, because there's less leaks. That's better. And then I'm not having to pay as high of a water bill. But then also I put in some low flow shower heads and newer toilets and that type of thing. So was able to shave off, let's say, $100 off the water bill. Now, $100, it's kind of a lot on a water bill, but you might be thinking, $100? I mean, we're talking $100,000 property, or a lot more. Well, why would that change much? Okay, so here's the thing. We do it on an annual basis, okay? So the $100 a month would actually be, times 12. So then we got $1,200 a year. Again, some of you are not getting excited about this yet. $1,200, whoop-de-woo, over a whole year. Guys, that is not how the value changed. Check this out. You would divide that, because that's the new NOI. That's the change in NOI. The NOI increased by $1,200. By me cutting the water bill down, that didn't change any of my other, income. It didn't lower the income by $100. So it actually changed the net income by $1,200 a year. All right. Well, $1,200 a year, you would divide that by the cap rate. Okay. So divided by 0.07. So $1,200 divided by 0.07, because this is a percentage again. That is, I think it's $17,000 divided by 0.07. Yeah, guys, that's $17,000. So look at that. If it's at a 7 cap, if someone's willing to pay a 7 cap for this, if that's what the market is, then a $100 change a month in the NOI is $17,000 of increased value. I mean, you'd have to refinance to get that out or sell it. But Isn't that cool? $100 a month, $17,000 of value. This is super cool. This is what all the big players are doing as far as the a 50-story apartment building or hotel, warehouses and stuff are all valued based on this. This is super, super cool. So the NOI, guys, that is where it is at, okay, the NOI. Again, the cap rate, the value, those are all interlocked in this formula. So just like any science or math class, you have a formula. That's the formula set in stone. If you know some of them, then you can flip it around and reverse engineer to get the answer. If you know two, you can figure out what the other one. And you can ask what the trailing 12 was. You can ask what the going rate is. Look at a couple deals. And you could see what they actually have it listed for. But because you can pull these levers, it's just really, really cool. I get super amped about this because let's say you did $200 a month. I mean, it's really neat, guys. There's a lot of leverage and different levels of risk when you get into commercial real estate. But the cool thing is, this is where the added value is by making it a more profitable business. So when you make a business more profitable, then it's worth more. Crazy, huh? You guys have a good day. Thanks for watching.